Hey everybody, it is good to be here with you. I'm glad to be here with you. It is Friday. That means it's time for condors, calendars, and butterflies. And I see some familiar names in the chat. Glad you're here. I'm going to talk about the latter of those three, butterflies, today. So we're going to hit that up. But before I get too far into this, let me just make an announcement regarding this webcast. In a couple weeks, so starting in June, we're changing the name of the webcast back to what its old name used to be, essentially, which was Advanced Options. I think we tried to get a little more creative with the name, but it also maybe misrepresented a little bit of what the strategies we were going to cover in this class. So it's going to go back to Advanced Options, and in that we'll continue to talk about condors, calendars, and butterflies, but we're also going to talk about things like straddles and strangles and other strategies, diagonal spreads and whatnot in there too. So that's in just a couple of weeks. So don't get thrown off by the name change. Um, it's I'll still be here, same bat time, same bat channel there. And as in the chat, James, I think originally mentioned Memorial Day weekend, everybody. So I wish you all a good Memorial Day weekend. Before we get too far into this, though, let me just mention a few things. One, I'm joined by James in the chat. Appreciate you, James. I've been working with James a lot of years now, and I've learned a lot from James over the years. And I encourage you to check out some of his webcasts, and you can follow either of us on X at Brentmore CS, at James Boyd CS. Now, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general, informational, and educational purposes only. Nothing we're going to go through today is individual recommendation or personalized investment advice. With long options, investors can lose 100% of the funds invested. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Your paper money application, which we'll be going through, doesn't do that. Doesn't assign short options early, but the paper money software application does a lot of things well, but that's just a difference there. It is provided for educational purposes only. And all investing involves risk, including risk of loss. Schwab does not recommend the use of technical analysis as the sole means of investment research, and past performance is no guarantee of individual results. We'll look at individual symbols today, individual stocks, individual trades. None of those are recommendations here. This is the market. We're up. And kind of like a flaggy pattern here on the S&P 500. And so that's that's kind of generally a bullish trend. Of course, this is all dependent upon what goes on in the world. But even with all the kind of bad stuff that's gone on in the world, the market seems to be shrugging it off. And I don't just mean geopolitical events. I mean things like interest rates are, pretty high, very concerning for a lot of people. Inflation rates are kind of concerning for a lot of people. The market seems to be shrugging that off fairly well, though. So, there we go. I want to look at individual stocks, but one question that I want to address right from the get-go is, where do we find stocks for these option trades? Because liquidity does matter for option trades. And I've shown this before, but it's been several months here as to where do I find most of these stocks where I'm looking at them. What I did was I look at a watch list and that I've created, which is just a liquid stocks watch list. Now you can create the same watch list if you want. I can share it with you, of course. But the way it started was I did a scan and I looked for stocks that are in the S&P 500 that have penny increment options. S&P 500, penny increment options. I put a minimum price of it of $20, although that, I don't know if we even need that. I mean, 95% or more of the stocks are probably going to have a minimum price above $20 anyway. But I also put an average volume greater than, here I have 8 million shares a day. And that tends to give you a pretty good selection of stocks. Of course, you have to check any trade you look at individually for it, for the liquidity of the individual option. But this gives you a pretty good starting point, I think. and then you can look at the technical analysis on this. Once you save this, and you just go up here and you can save your scan query. In this case, I'm going to share it. I'll share that with you. Let me just do liquid stocks, liquid stocks. We'll just put a 1 after that. And I share that. And what I'm going to do is I'll throw that in the chat. Okay. And I think, if I'm not mistaken, it's in the description of the webcast as well. Yeah, it's already in the description of the webcast. If you're watching on a recording, then it's there for you. But the key thing is, once you have the scan and you save it, it then becomes a watch list. So then when I pull up the watch list, liquid stocks, it's just going to be in your personal watch list. Then you can just go through, link the watch list to the chart, and you can scroll through these real easily. Now, so that's, I just wanted to address that as to how I'm finding stocks. And I'm not saying that's the way you got to do it, but I'm just saying that's, an approach that I use that we get a question on quite often here on this. Let's start off though, and because we're talking about butterfly spreads today, and butterfly spreads are kind of nominally a neutral type trade. And so if you're finding stocks that are more, say, not neutral, maybe you're looking at a stock like this and you're going, well, it's been kind of going sideways, but when I look at it and I see this kind of pattern here, this triangle pattern, I'm expecting it to break out significantly the upside or the downside. Okay. And so maybe we want to do a butterfly spread on that because number one, we don't know which direction we're going. And number two, if it breaks, we'd consider that to be likely a significant break. So that's probably not the type of trade we'd be looking at for a butterfly spread. Instead, we may look for something that's more, you may deem it to be a little bit more neutral. And for that, of course, we're going to start with technical analysis. Okay. So let's start with some technical analysis here on this. So what I'm going to do is I'm just going to say, I think from a technical standpoint, I'm going to consider that a support level, okay, around 24-ish, okay. You can see we've bounced off that multiple times. If I extend the chart out, I think we'd get more points on that. But you can see that chart right there. That's kind of what I'm going to call my support level. And I can go up here and I can say, well, we've bounced off here a fair amount around this 26 level, okay, gap down to it, bounced up, tested it, kind of traded through it, went to it, bounced down below, and we're now going up, and it appears the momentum's changing a little bit. We had a nice big candle, big green candle, then we got a medium big candle, green candle, and now we actually have a little bit of a red candle. Shows like it may be showing some support here. And of course, what you can always do is you can always go and say, well, we have high and lower high, and maybe we're going to get a bounce here. No guarantees on that, but that's my rationale for looking at this stock and saying, I think there's a good chance we're going to come back down more into this range here. And that's one of the key things when you're talking about a butterfly spread. And we'll talk about how to construct that spread in a second. But the first thing is, think of your target price. Where do you think the stock is going? In this case, I'm going to say, generally kind of in this range, in between my resistance and my support level. That's generally the area. Now, obviously, it's probably not going to go right there and stay there, but that's going to be your initial target because you're going to have 3 strike prices, and the middle strike price in there is going to be your target price. So you're going to buy a contract. You're going to sell 2 contracts, minus 2 contracts, and you're going to buy another contract. The middle strike is your target price, okay? The upper strike is probably going to be the kind of the upper range-ish of where you think the stock is likely going to be. And the bottom strike is going to be the lower range-ish of where you think the stock is going to be. And then we can tweak that. So that's the basics of a butterfly. Now, calls or puts, it can be either remember, short options can be assigned earlier. So generally what we're going to do is, if we're not doing it right at the money, we're going to try and keep those short options out of the money. Okay, so in this case, if we think the middle strike's going to be down here closer to that mid-range of 25, we're probably going to do puts, because it would put those puts out of the money. If we thought the stock were to go up here, we'd probably do calls, because the calls, the middle strike, we'd keep those out of the money. So that's the basics of where we're looking at here on this. And Chris said, in this case, we're going to look at puts. Now, you may look at this, and different people do different levels of, have different expectations of what a stock is going to do. And so we're assuming this kind of technical analysis, what we're going to do here. But I'm going to say, I'm going to go out a little ways. I'm going to go, maybe not exactly, I'm going to expand my range a little bit, but I'm going to say that 24 is going to be the center. Because if I go 24, and this is just kind of comes from experience, I'll tell you this. If I do 25, as my middle strike, and I see 26 as my long strike and 24 as my short strike, that's going to be too tight, okay? We just got to play around with it a little bit here. But what I'm going to do here is I'm going to go back here, and I'm going to go to the trade tab, and I'm going to go to CCL, and I'm going to go out, I'm going to go to the monthly options. I'm going to go out just under a month here, 27 days, clear enough. I'm going to go to the puts, as we mentioned. Let me get some more strikes here, okay? Let me just put in a bunch. Okay, I don't need that many probably, but we'll go with it. 25, I'm going to go to that 25 strike. I'm going to sell 2 of those, and then I'm going to widen it out. Now, I can do it individually and click on those, or I can click right here, click on butterfly, and just pick the middle one as 25 in this case. I'm going to go to my puts. It's a debit spread, so I'm going to click on the ask price. Now, it doesn't know what strikes we're going to do, so it's just putting them out a half a point. That's going to be really, really narrow. So I'm going to widen this out a little bit here. And I'm going to go out to 27 or 28. And what I'm going to do is I'm going to kind of make it equidistant there. Equidistant. So if I have a $3 difference between my middle and my upper, I'm going to do $3 difference between my middle and my lower. So that's going to be 22, right? So we're going to go here to 22. And then what we're going to do is we're going to look at it. And we're going to see if we like it, if we see how it looks. I'm going to right click on it. I'm going to analyze the trade. I'm going to go, and here's what it looks like. Okay? That's what the trade looks like. This is a classic, that's what a butterfly looks like. Kind of goes like this. Think of a tent or something like that, and that's what it looks like. Now, sometimes it will go like this. It'll go like that, and really skinny, and you go, my strikes are probably too narrow. If it looks like that, you probably didn't widen these out enough. Okay? Because like when we originally did it, let me clear that out. When we originally did that, we were saying, I said, well, I think it's probably going to be too tight if we do 26 and 24, I think. You see how that's tighter? Okay. You see how that's tighter? So that's what we got here. Okay. Now, let's see, June 19th, let's just set slices, break even. And you can see how narrow our break even points are on this. It's kind of hard to see. Let me just shrink this down here a little bit. And let me do this. And you see it's saying like, it's got to be in this little range with those strikes. That's too tight. Now, for those of you who aren't familiar with this graph that I'm showing you, this is a profit loss graph. This represents profit or loss. If it's a negative number, loss, negative number. And you can see there's not much in the profit area there. Clearly, that's not working. I have price slices set to break evens. These red lines right here, I think this is what you're asking there in BH. the little red lines right here and there are just where we're crossing the break-even point on those, okay? But this isn't the trade we're going to do. We're going to tweak it because because you're not going to know exactly how wide to go. So that's why you use this tool. And I think we said we were going to do 28 and let's do 22. And when we do that, you can see these break-even lines right there. If we set our slices to break even, they're a lot wider. Okay? They're a lot wider. Now, one point here. You can see this little red line here. It's a little hard to see, is where we're crossing the break even. Notice we have a couple other little red lines. Those other couple little lines are where our break even is on basically this date, which is today. Okay. So that's not what we're concerned about. We're looking at the blue tint, so to speak, which represents expiration. That's the ones we care about right now. But now you're saying, Brent, that's not a high probability trade. You're right, it's not a high probability trade. And I'll tell you, I'll be upfront with you right now. Most butterfly spreads, in fact, let me say, the vast majority of butterfly spreads are not going to be high probability spreads. Okay. If they're equidistant, even balanced butterfly spreads, they're going to be lower probability trades. Now, the nice thing is, if we hit it well, we stand to make a lot more than we stand to lose. Okay? Because here's our break even. Here's our max loss right there. Okay? Here's our break even. Here's our max loss right there. Here's our break. But here's the thing. I don't want to count on my break hitting our max gain because the odds of hitting that are pretty slim there. That's not why we're doing it. What I am going to do though is I'm going to take this and I'm going to right click and I'm going to set my slices to break even on the chart, set slices to charts, break even on the chart, and hold on, let me clear this drawing set because I have extra lines on there. I'm not sure what we got here. Let me try this one more time. Set slices to charts. There we go. So that's the forecast for us right there. Okay? That's the current forecast of where we need this stock to be. I said up front, I'm expecting this to go down a little bit. This trade would make no sense if I expected it to go up because we're pretty close to where our break even and expiration is on the high side. But it gives us, we're using technical analysis to try and help us in this quest here. So there we go. That's the trade right there. We say it's more neutral, but you can skew it a little bit more bullish, a little bit more bearish. In this case, we skewed it a little bit more on the bearish side of things. So what I'm going to do is I'm going to trade this. Now, how are we going to manage this? First of all, I'm going to confirm and send this, or you can do multiple contracts. You can click on confirm and send. My max loss on this is $88. Max profit, $212. Not a high probability trade. Reward to risk is positive here in that regard. But as I mentioned before, don't put too much into the reward to risk because hitting that max profit is not likely. We don't want to wait for it to hit a max profit before we exit though. Let me edit this. I'm going to actually just do I'm going to do a multiple of that. I'm going to click on confirm and send. I'm going to go to butterfly spreads. And I'm going to send that order. Okay, there we go. Now, how are we going to manage it? When we look at this, obviously we know where we want it to go. We're buying the spread out a little less than a month. Okay. little less than a month. And it's a positive theta trade. Time decay helps us out. So Chris says, what's the benefit of going out this long on a butterfly than trading something with less time? Well, there's pros and cons, of course. One of the cons is we're trying to predict out further in time in terms of the technical analysis. And it's the further out in time you're trying to predict out, probably the harder it is to know where things are going to be. So we don't know on that. One of the pros is, because this is a trade that benefits from time decay, we're giving it more time for that time decay to take place there on this. So that's another benefit. Also, I think if we look at this and say, I'm only going to go out less time, number one, just look at the probabilities of the trade. When you're analyzing these trades, you kind of need to look at it. You need to, let me just uncheck. I'm going to show, we're going to hide the positions. And if we change this and tweak this for something that's shorter, let's go to June 5th, how about? Okay, we'll go to June 5th on that. Let me do this. Just double check and see what you got. There's less time for it to go your direction, less time for time decay to take place on that. But you can certainly do that, a shorter term expiration. Another thing to be careful about, though, is if you're doing these non-monthly expirations, pay attention to your spreads, because sometimes the weekly contracts have worse spreads there on that. Okay? Now, let's talk about this trade a little bit. Butterfly spreads, generally, we're going to consider them more non-directional. Positive time decay, positive theta, as I mentioned on that. Let me just show all here on this. Negative vega trade. So where does this differ from a calendar spread? Calendar spreads, positive time decay, kind of a neutral trade, but your vega in this case is a negative vega. Drops in implied volatility would help us, whereas on a calendar spread, increases in implied volatility would tend to help us on that trade. The center strike is the target. Consider the outside strikes, 22, 28, as kind of a rough estimate of your sidelines of where you want to stay within. Now, we already looked at the chart. We put these lines on here. So we have a little bit more wiggle room, because I think we said support was down here a little, like there, okay? And so that's, we have a little bit more wiggle room on that. But that's the general area of what we're looking at. The outside strikes aren't exactly where our break-evens are going to be or anything like that. Once we get near expiration, a week out to expiration, we're probably going to look to get out of this trade. But if you look at this trade, remember, we did a long put. Okay, I'm just going to put a plus P. We did a short put. We did another short put. We did two short puts and another long put. If you consider these like this, this is a bull put vertical spread. This here is I shouldn't have used a B because bull and bear both start with B, a bear put vertical, or a long put vertical and a short put vertical. This is a bearish trade. This is a bullish trade. Where the two meet with the common strikes, that's where our target is. That's where the max gain is. When you're managing it, you can look at these individually. Regardless, we're probably going to look to get out with about a week to go to expiration. If your bull put vertical makes about 80%, ignore the bear put vertical. If the bull put vertical makes about 80%, if it's doing really well, just get out of it. If the bear put vertical is making good money, get out of it. Don't wait for 80% profit on the whole thing though, because you're going to be waiting probably all the full time. You're probably not going to achieve that. That's very difficult to achieve. Now, there's one other thing. Our goal is for this stock to go like this. It's okay if it kind of goes like this. It's okay if it goes down a little bit more. But if we start to trend up strongly like that, and we go, this is no longer bearish trade, it's a bullish trade, we're going to look to get out. We're going to have technical exits there on that. Okay, so if we break down technically, we're going to get out of that trade. Now I want to look at a different example here. Okay, let me put in. Let's look at J.P. Morgan. Okay, so here's another one. Remember, it's going to start with your technical analysis. Now, let me just hit some questions up here. Do you check the open interest or volume of the chart? So I don't care particularly about the volume of the option itself. I care about the open interest and, more importantly, even the bid-ask spread of those trades. Okay, but I don't usually even bother putting the volume column up for the option itself. Now, at the beginning of the webcast, we said, I'm looking for at least 8 million average volume, I think is what I had on my scan, for the underlying stock itself. Because I'll tell you, if you find a stock that trades less than 1 million volume, for example, your hopes of getting liquid options are probably pretty slim there. But when it comes to volume options, worry more about the bid-ask spread, worry about the open interest, if you like, but not the volume of the options themselves there. Now, I said, if you're going to manage this as two individual spreads, which is what I kind of encourage you to do, a long put vertical and a short put vertical, I said, if you're going to look at these individually and you've made 80%, 70%, it's not an exact recommendation, you can get out. Chris said, what if we're looking at the whole thing together? What should we look? I don't know, 30 to 40% probably, something like that. I think you said 35%, which is perfect, right in there. Something like that. In other words, we're not going for don't expect to make the whole thing there. Get out when you've made a decent profit, 30%, 40% of the whole thing. If you're looking at the individual sides, you probably want more than that on each individual side there. So good question. Now, let's look at J.P. Morgan. We're going to start with our technical analysis. I'm going to start with support and resistance and trend. I'm going to call this kind of a resistance level up here, right up there. You can see why I drew that right there probably. Went up in that range and we bounced down. Support, well, probably kind of in this range. Okay, we bounced quite clearly off that level there. That's going to be my support level. We have more support down here, okay? Probably about that 280 level, something like that is more support. You'll often have more support levels, resistance levels. Would this be a potential level right here? Yeah, but this is like right where the stock's at right now. It's probably not doing me much good there. We do have some upward momentum on this. But my assumption is we're mostly going to kind of stay in this range, this kind of neutral range. We're up a little bit more towards the upper end of the range, but I'm going to call this pretty neutral. So I'm going to pick my target strike, so to speak, right around that 300 maybe. So let's do that. Consider the trend, right? I've kind of focused on support, and resistance. You can look at your moving averages to help you. We have, this is your 20-day moving average. You can use different moving average. It's sloping down. We're just kind of breaking above that today. Not a clear succession of higher highs and higher lows, or lower highs and lower lows. It's not a real strong trending stock in that regard. Okay, so if we pick that 300 as the middle strike, so to speak, then I don't know. I'm going to say 280, 320, 280, but maybe we'll tweak it as the outer strikes. That makes it nice and symmetrical. Middle strike, $20 difference on those. But we'll look and maybe we'll find something better if we tweak it a little bit. But I'm going to put in something to start. So let me go. I'm going to stick with the monthly contracts. And if you want, let me go to single. And you can look for your open interest here on this. Here's your open interest on these. Oops, let me go down. And 300 is below the current price. So I'm going to do puts. I'm looking at puts. And you can see like some of these don't have much in the way of volume. 6 contracts, 7 contracts, 3 contracts. I'm not as worried about that as my open interest. I'm going to sell the 300 and I'm going to buy the 280 and buy the 320. Okay. I'm going to go butterfly. Okay. I'm going to go find 300 was our middle strike. So I'm going to find the one with the 300 on that. Put that on, and I'm going to tweak this. The default on this, if you just click on that, is almost always going to be wrong. It's not theoretically incorrect, but practically it's going to be too tight. I can't do a 300, 302, 297 butterfly. It's just not going to work. So we're going to go out. We said 320, and we're going to keep it symmetrical. We're going to go to 280. Okay. Now, here we go. Let's pull this up because there's a good question here. Here's our IV, okay? Volatility. What happened is stock kind of it had earnings, kind of went up, and then it kind of gradually climbed up and went sideways, and then it went down. And here we go. Right now, it's kind of going sideways. If you're very concerned that this is going to go up in volume much, then we'd probably be looking more at a calendar spread than this, okay? Than that. This isn't a very volatile stock that moves a whole lot here on this. And primarily it's going to be with earnings that we're going to see the volatility shifts. Of course, who knows? Anything in the market, the world could happen right now. And geopolitical events can affect volatility as well. But let's take a look at this. I'm going to analyze this trade. Here's the trade. And let me go to risk profile. And I'm going to maybe tweak this a little bit. Let me set my slices. This is today's date down here, 5/22. This is our expiration date, which is June 19th. Let me set my slices to break even. Okay, so there's our break even spots, but we can tweak it. If we want to see, we can see can we widen this out a little bit? Maybe if I widen the strikes out, I can do that. I can narrow it as well and see. So you can play with these. I can go to 325 and 275. Let me set my slices to break even. Okay. It's a high probability butterfly. Does that go in, I said earlier that typically they're not going to be high probability. In this case, it's a higher probability butterfly. However, we sacrifice something with that. And that is, hold on one sec. Let me go and just make sure. Hold on. I didn't unlock I need to unlock down there. Let me set my slices again. I'm not sure if that's going to hold up. I've done the wrong thing. Set slices, break even. Okay, well, roughly 50-50. So we're not quite there. But anytime you shift those prices, you're going to shift your reward to risk ratio. If I look at this and I say, confirm and send, and look at this, my max profit is still a little bit above my max loss though. The further, if I shift those out farther though, those strikes out farther, the wings out farther of the butterfly, this will shift and our max loss will be greater than our max profit on that. So you can always tweak the trade if you like on that. And I'm going to create a, let's confirm and send, okay? So there's that trade. Now I want to show you a different example entirely. And that example is this. Oh, by the way, neither of these are filling right now. Let's just see if we can get these to fill. That's, my price is, there we go. There's one of them. And we'll let this one sit a little bit and see if we can get a fill on that. I said sometimes we can look at directionality on this, okay? So here's directionality on this. This is Intel. This is one where implied volatilities are already a little higher, okay? It doesn't mean they can't go higher. Just looking back at the last 6 months, our implied volatilities are higher than they've been most of the time there on this. Okay? So that's looking at implied volatility on that. What's our trend? Well, and our support and resistance. Well, in terms of resistance, I guess I'd say, where we bounced off recently, right up there, would be not strong resistance. There's just one bounce off that, so it's probably not, hardly even worth mentioning there. Probably support down here, and maybe we had a little gap most recently, short term, right there on that, okay? But what's our technical analysis? Our technical analysis is, I would say, we have an upward trend. Goes up, 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 kind of a flag pattern, a break of a flag. This is a bull flag pattern. This is more bullish. So what we can do is we can skew this a little bit more towards the bullish side. Maybe I'll use this as a target, okay? Maybe we use this as a target about, what is that? That's about 130, okay? 130. And I'm just going to wing it right now. I'm going to put something in and then we'll tweak it a little bit. So I'm just going to say we're going to go 30 points wide on this. Okay? Clear my drawings. Get out of this. I'm going to go to trade. And I'm not going to go out June 18th on this one. Let's go a little shorter term. Let's go out 21 days on this. And we said our middle strike was going to be 130. Now 130 is above the current price. Am I doing puts again? No, we're going to do calls again. I'm going to click on the ask price. Clearly this is too tight. I'm going to spread this out wide. The more volatile the stock, and Intel's a pretty volatile stock, the wider we can spread those out. I'm going to make that 160. Now, I may tweak that a little bit, but let's see what we got there. And then we just filled on our JP Morgan trade. Let's analyze this spread here. Hold on one sec. Let me just, yep. We're going to analyze this trade and see what we got. That's what we got. Now, this is a totally neutral trade. What I'm going to do is I'm going to make it a more bullish trade. You can skew the butterflies to make it more bullish or more bearish. So in this case, what I'm going to do is if I want to make it more bullish, I'm going to take this 160 and I'm going to move that down. Let's make it 150 and take a look at it. 150. And you can see what it looks like now. Now, yeah, we have more risk on the downside here. But if it goes up, this is our target. This is our short-term target. But if that trend continues to go up further, I'm not risking that much. I'm risking a little bit there. Can we get this so this line is actually above the break-even line so that we only have one break-even on this? Yeah, if we move it up enough, probably. Let's do it. Let me tweak this. We said that was 130. What if we make this I don't know, 145? Does that do? Yeah, barely. It makes it, that puts it above. You can play with it even more. 140. Oh, now the butterfly spread is just not as neutral trade. Now, it's not the most bullish thing in the world. If I'm super bullish on Intel, maybe the long call makes sense. But in this case, I've turned it into a trade where, let me just add a slice here, where we're still positive theta. So that's the difference between that and the long call. Vega's still negative on that. And our max profit occurs if we go up towards that 130 level, but we still get a decent profit, around $550 roughly, if it continues to go up. Now, if it goes down below like the 115 level, that's trouble. We don't want that. So this is our support level. We want this to stay. So maybe we'll look to get out if the stock breaks below this level on this there. Okay. So there we go. Okay. So this is a bullish trade on this. Okay. And I'm going to go here and let me just go back here and I'm going to confirm and send. I'm going to put this in butterflies and I'm going to send that trade. All right, there's the trade. So what did we do today? We talked about butterfly spreads. We talked about how they're generally more of a neutral trade. We talked about how they're constructed, how we can skew them a little bit more bullish, a little more bearish, depending on what that center strike is. We talked about management. Remember, if we get to be about a week till expiration, we're going to look to get out. If we've made, I don't know, 75, 80% on either of the wings, we'll look to get out. If we have a technical breakdown, like on Intel, if we turn bearish instead of bullish, we're going to look to get out. We'll probably have to take a loss at that point, but we'll try and minimize that loss there. And how time decay benefits you on this trade. It's a positive theta trade. It's a negative Vega trade there. All right, everybody. So thank you for joining me on that. That's butterfly spreads. Hey, coming up next, we've got market and sector analysis. I think Mike Fairborn's teaching that today. Make sure you check that out. And thanks, James, for helping me in the chat. And I appreciate each of you for joining me. And we'll see you all same time next week. Bye-bye, everybody.